Oh, this is 39.6 Facebook and YouTube Live Finance Show is episode number 91. Today is October 4, 2020. This is 39.6 Facebook Live and YouTube Live Finance Show. This is a show that teaches high earners like yourselves how to make your money work for you so you don't have to work for your money. We talk general investing, taxes, real estate, syndications, Airbnb, paying for college, childcare, and even the car you drive. We continue tax week with episode number 91, Getting to Zero Tax Part 4, Schedule D, Capital Gains and Losses. Now, as you recall, back on episode 83 a week ago, we went through Petition on Fire's tax return, the 1040. Yesterday we did Schedule C, the day before we did Schedule B, and the day before that we did Schedule A, itemized deductions. Today we move on with Schedule D, Capital Gains and Losses. This is a pretty simple one. It's not going to make a huge difference in your tax return, but it does certainly make your taxable account more efficient because of tax loss harvesting. Now, in a taxable account, if you sell an investment at a lower price than you purchased it, which would be called its cost basis, you then are able to harvest a taxable loss. And that loss is able to help you save in taxes. In episode number 78, we discussed tax loss harvesting and qualified dividends. Okay, this is actually our Schedule D from 2018. Now, the first part of the Schedule D, and I'm going to make it bigger here. There we go. The first part of Schedule D is for short-term capital gains and losses. So these are for assets held for 1 year or less in general. So this could be a stock that you purchased within the past 365 days and then sold. Or it could be a property like a real estate asset that you bought and sold within a year. Okay, short-term capital gains are taxed as ordinary income at your highest tax bracket, your marginal tax rate. Long-term capital gains, items that you have held for more than a year. If you sell them for more than the original price, they are long-term capital gains and taxed at favorable tax rates. If you lose money on either a short-term or a long-term asset, that is considered a long-term capital loss or a short-term capital loss, based on how long that asset has been held. Okay, so they separate the short-term capital gains and losses into Part 1. And in Part 2, they have long-term capital gains and losses. So in 2018, we tax loss harvested multiple times. And each time you sell an asset, that would be listed under proceeds. And then if you buy something else, that would go under cost. So if we had tax loss harvested just, let's say, $50,000 of assets, but then we sold it and bought it, or something else, sold it, bought something else, sold it and bought something else, sold it and bought something else, did that 10 times, then you get up to like $500,000. So this $529,500 isn't actually $529,500 that we sold. That is the sum of all of the sales that we had throughout the entire year, which could have been the same money being bought and sold over and over again. Okay, because our taxable account does not have this much invested in equities. So the total proceeds here was $529,500, and the total cost was $542,000. Sorry, I just realized it's not showing up. There we go. $542,000, $542,044. If you subtract how much it cost from the amount you get, that will give you your capital gain. Well, in this situation, that is a negative number. It is negative $12,544. So in line 7, where it says net short-term capital gain or loss, it is negative $12,544. We were able to harvest $12,000 of losses. And when I say harvest, that's just because we're trading one fund to a similar but different fund so that it's basically going to get the same return, but it's not exactly the same fund or exactly the same index that they're tracking. So they're not substantially identical. In so doing, we are able to harvest that loss. Our money is still invested in basically the same assets, but that loss we were able to pull out and throw it here on Schedule D. So those are short-term losses. And then long-term losses, we have $19,563 of proceeds on a $20,000 purchase price tax lot, and that gave us another loss of $437. Okay. So in total, if you add these, so the last thing is you get your net long-term capital gains or losses. So we have negative 437 for long-term and negative 12,544 for short-term. In total, combining these two, it is negative $12,981. So if one of those was positive, let's say that my long-term gains was actually positive by like $1,000, I would offset part of that negative 12,544 from the short term, and it would only be negative 11,500. But because they were both losses, we just add them up. And so here we are at negative 12,981. You cannot put negative 12,981 onto your 1040 form. You are only allowed to use a loss of $3,000 above and beyond all of your other gains. In this situation, there were no gains, but let's pretend there were $5,000 of gains. They would have been offset first, and we would end up with negative 7,981 instead of negative 12,981. And then of that negative 7,000, 3,000 would carry forward to the 1040. So you're allowed to offset all of your capital gains. And if there's any left over, up to 3,000 of that can be put onto line 21 here if you are married, and then this can go get transferred to your 1040 form. Okay, so on the 1040 form, like we saw before with Physician on Fire's tax return, I'm going to stop screen sharing that, and I'm going to switch to the other one. And here is the tax return again from episode number 83. And I'll try to zoom in on that a little bit more. Okay. Sorry. Okay. Making it bigger. There we go. And if you remember here on line number 6, capital gain or loss, attach Schedule D if required. So here it is, negative $3,000. So you can send $3,000 over here to your 1040, and that will subtract from your line 1 wages, offsetting your ordinary income. And if your top tax bracket is 37%, that $3,000 tax loss is worth 3,000 times 37%. That's like 1,100. Let's see, 37 times 3 is 90 plus 21 is 111. So yeah, that'll save you $1,110. So what that will do is actually make your taxable account even more tax efficient. That will offset a substantial amount of capital gains. It will offset, of dividends. It'll offset like $4,000 to $5,000 of dividends potentially, depending on what tax bracket you're paying your dividends at. But your taxable account, because you can capture tax losses and that offsets ordinary income, that will actually help offset the dividend tax you pay, such that your taxable account can be super tax efficient. You cannot pay capital gains if you just avoid selling gains, and you can offset dividends. So, or just your ordinary income tax. So that helps bring your tax liability and your AGI closer to zero. Not a lot, but a little bit. And every little bit does count. And this is a freebie. In a year like 2020, people with a big taxable account, if you had $3 million, you could have harvested like $1 million this year. And $3,000 of losses could be offsetting your 1040 basically every year going forward. Then when you're retired and not working anymore, you can actually, this is crazy, you can harvest gains in those lower tax brackets, 0, 10, 12%, and increase the basis such that you can really pay very minimal tax on a taxable account over your lifetime. It's a little bit more complicated. We'll have to do another episode on that. But there you go. That's Schedule D. And that wraps up. We covered A, B, C, and D. Now at least I have an episode to refer to whenever people ask me about Schedule D. Episode number 91. Again, this is not legal, financial, accounting, medical, other advice. Simply my entertainment, hopefully yours. Until tomorrow, this is brought to you by our sponsor, the Medicine, Marriage, and Money podcast, with episode 4 coming at you tonight, being released in 34 minutes. Have a good one.